This is Paul Donovan from UBS's Global Economics Department. With a huge cheer, Asian markets are crying as one, the Chinese are coming. Like the United States Marines, China's stimulus package of $586 billion over the next couple of years is seen as the ultimate rescue plan. Of course, it amounts to a little less than 3% of US consumer spending over the same time frame, but we must not be churlish. This is important for China, and if somewhat less important for the rest of the world, it does still matter. There is a 10-point plan, of course, which gives fairly meaningful amounts of detail. The detail is investment and construction in the main, which suggests that construction equipment and materials will be the principal beneficiaries. We view bank lending as the more important driver for growth over the medium term. Bank lending is 110% of GDP, fiscal spending is 20% of GDP. Basically, the plan endorses our view that China will compensate for some, but not all, of the weakness that comes from the shocking state of the global economy with the attendant problem through export growth. We affirm our 7.5% growth view for China next year. The US media is reporting that Comrade Fulton is not to be outdone by his peers in Beijing and that the plans to socialize the US economy will be continued. AIG is reported to be negotiating a new, enhanced bailout package worth $150 billion, which replaces the existing loan with one of 5-year duration and throws a bit more net new money into the mix via the TARP. The Security Pacific Bank became the 19th bank to close in the States and the 3rd bank to close in California this year. By comparison, something like 4,000 banks closed at the onset of the Great Depression of the 1930s, so there's still the target to aim at. Meanwhile, credit rating agency Standard & Poor's cut General Motors to CCC+ credit rating and warns that it may cut further, and it assumes some kind of assistance from the government for General Motors as well. Over in Japan, foreign exchange reserves were below yen 1 trillion for the 3rd consecutive month. This is due to valuation rather than flows. Japan reports that it did not intervene in the foreign exchange markets in the period until the end of September. There was not much expectation that they did intervene in the foreign exchange markets then, as the yen was generally above 105 against the dollar. Of more interest is what the Japanese authorities did as the dollar-yen rate plunged during October. The G20 pre-meeting meeting took place over the weekend and, to judge by the communiqué, was a monumental non-event. Brazil's foreign minister complained that developing economies were hauled along to G7 meetings only to take part during the coffee breaks. The history of international economic agreement does not suggest that anything terribly spectacular is going to emerge from next weekend's formal get-together in Washington, beyond the chance to be photographed next to Senator Obama, of course. Bretton Woods was essentially a deal pulled together by the UK and the US at a time when the UK and US could be relatively sure that the rest of the world would do what they said. Even then, the deal was fundamentally flawed. The idea that a multipolar world is capable of reforming the international financial architecture over a weekend is not terribly plausible. That's all for today. Have a good day.